Okay, let's get this webinar started. Welcome, everyone. Welcome to the TradeStation's Options Education Series. Today, we have a guest speaker from the OIC, Matt Cashman. We're going to pass the microphone over to him in just a moment. I just wanted to talk through some of the things that we're doing here at TradeStation regarding options education, like participating and collaborating with the Options Industry Council. But in addition to that, creating a lot of educational content to help you in your options trading. If you haven't visited the Options Education Center, I'm going to encourage everyone to do so. I'm going to be sharing a few links as Matt, does his presentation. But we've created an Options Education Center where we post articles on specific option strategies, and also we've posted many archive webinars that we've done in the past. So I want everybody to come here, explore the content, because we do have, within the content, we have custom workspaces, custom PDFs that you can download, even custom studies that you can use on your TradeStation platform. So I am going to be sharing those links in just a moment with everyone here in the chat. So please explore. And if you have any questions, please contact us at education@tradestation.com. For those that don't know me, my name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. For me, it's always a pleasure to be here on these type of settings because I get to talk to you. I get to show you, tips and tricks of the TradeStation platform, and introduce guest speakers as Matt, that we're gonna have the privilege to hear him out in just a moment. Let me go through some of the disclosures before I pass the microphone over to him. But I just want to say that every single idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, especially when it comes to trading options, which carry a higher degree of risk. Past historical performance is no guarantee of future results. And if anybody wants more details on the disclosures, go to www.tradestation.com/important-information. All right, guys, let me go ahead and stop my share. I'm going to introduce our guest speaker. Matt, we're very happy to see you today. I'm going to pass the microphone over to you so you can get started, okay?
Awesome. Thank you very much. I hope everyone can see and hear me. It looks like everything's up and running. Thank you, everyone, for joining us today for the TradeStation OIC webinar on zero DTE options. One of the goals today is to really give you a baseline understanding of both the risks and the potential benefits of trading these shorter dated options by taking a look at how time and optionality are related more generally, and then putting a little bit of that together and giving you some really specific strategies and how they might look holistically from a risk reward perspective. So hopefully we'll get there today. Today, we're going to embark on a fundamental approach learning these concepts. My hope is that through this, we're going to find a way to build up your base level of understanding on how shorter dated options work more generally. As always, our goal here is to offer you educational resources that can meet you where you are. And this presentation on zero DTE is really just the latest incarnation of that. So I hope you find it useful, original, and ultimately helpful in building your knowledge base surrounding these options. My name is Matt Cashman. I'm the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. Quick background on myself. I started trading around 1998. I've been an options trader ever since. Got my start in Chicago on the floor of the CBOE, and I traded options there for about 3 or 4 years before I moved to London. Traded options there for 5 years, traded interest rate options in London, and then came back and started an index options market making business, again, on the floor of the CBOE, and ran that for the better part of about a decade. Currently, I work at OCC, helping individuals and investors to better understand both risks and benefits of exchange-traded options through efforts like the webinar that you're watching on TradeStation today. Now, we always include our own disclaimer. It's important that we keep our lawyers happy. Options involve risk. Any strategy that I discuss, including examples of actual securities, strictly for illustrative and educational purposes. Please do not construe them as an endorsement, recommendation, or solicitation to buy or sell securities. Okay, enough of that. One other bit of housekeeping. The following trademarks, logos, and service marks displayed are wholly owned by the Options Clearing Corporation. You're going to see them used throughout the presentation today. Now, a little bit about OIC. This is important stuff here because it'll give you some resources that you can check out, which I think are really important and somewhat underutilized generally. The OIC is the Options Industry Council. It's the educational arm of our parent company, the OCC. OCC is the largest clearing corporation of equity and index exchange traded options in the world. If you trade options in the United States on equities or indexes, the OCC touches that option somewhere along its life cycle, either in settlement or in exercise and assignment, et cetera, et cetera. So it's important to understand where OCC sits and the fact that OIC is the educational arm within that. OIC started as a collective in 1992 to better educate the public as to the risks and benefits of exchange traded options. Currently, we do that through mainly our website, optionseducation.org. If you head over there, you're going to find online courses, podcasts, videos, webinars like the one you're listening to now. We are able to provide these services free of charge because we're fully funded by our parent company, OCC. Thank you, OCC. One other thing, really quickly, options@theocc.com. This is an email address that is staffed by 4 people on the investor education desk. Among the 4 people that staff this, they have a cumulative experience of over 100 years of trading and brokerage and just options in general. These people are not registered investment advisors. We are not registered investment advisors, so we can't direct you on trades. We can't suggest option strategies. But what we can do, what we do all day long and what we're really good at is educating you as to how the options work more generally, and then helping you to utilize that knowledge to understand your positions or your strategies a little bit better, and hopefully utilizing that knowledge to make better educated decisions going forward. So options@theocc.com. Don't forget that email address. It's very helpful, and you usually get an email answer the day that you send your email question. We try to do that as much as humanly possible. Let's dig in. Options volume from 2000 to 2022. I always utilize this slide because it's a really interesting way to look at volume. Over the last 22 years, 23 years, we've seen option volume absolutely explode. This was 10.3 in 2022. It became 11.2 in 2023. And this year, 2024, it looks like it's going to be over 12 billion, that's billion with a B, contracts cleared by the OCC on an annual basis. That works out to over 40 million contracts a day. I want you to take a moment and think about the amount of volume that is going through the pipeline of the options world, and then think about what that looked like 10, 15, 20 years ago. Because in 2008, when I was trading options in the S&P pit on the floor of the CBOE, we cleared about 3.7 billion contracts. And at the end of the year, I thought it was the most volatile and the craziest thing that I had ever seen, and that I would never, ever see volume numbers like that again. I was 100% dead wrong. It wasn't the first time I was dead wrong, and it certainly wasn't the last time I was dead wrong. But I don't recall being as wrong about that as I have in other ways. 12 billion contracts this year is probably what it's going to look like. Contrast that to 2008, 3.7 billion contracts. It's an absolute explosion of volume and interest in the product. That's an important thing, but it's also important from my perspective, from an educator's perspective, that I reach as many people as I can to help educate them so that they understand the risks that they're putting on. Options are leveraged products. Don't forget that. It's something that you should build into your risk matrix and the way that you think about your risk in the DNA of how you think about options. And that's what I want to drive home most broadly every time I do one of these presentations. And that's part of the reason I put this slide in at the beginning. Let's talk about how we're going to get to these 0 DTE options. We're going to talk about the steps toward daily expirations. Options didn't always have a daily expiration. It wasn't part of the landscape 25 years ago. I'll show you how we got there. We're going to talk generally about sensitivity of options as time passes. One of those sensitivities is gamma, which is an option sensitivity to movement. We'll talk about that relative to time. We'll also talk about Vega of options relative to time, because that's a component of this as well. Again, we'll talk about delta of options versus time. All of these have something in common. we're putting the Greek relative to time on the table so that we can look at what do options do from a Greek perspective when we either remove or add time to them. Because that's how I want you to think about these relatively short-dated options. It's just a function of how much time is in them. And you can think about that more generally, and it'll help you understand how these options might act when things are moving around, especially in extremely volatile markets like the one that we've had over the last 5 days. I'll show you a move comparison of some options that are closer to expiration and some options that are farther away from expiration. And we'll talk about how those options react and what you can glean from that actual situation. And then hopefully we'll have some time for Q&A. So when I created this presentation and ran it by my legal department, the first thing that they said was, what does DTE mean? And so I said, okay, well, let me put a slide in here to tell everyone DTE means. DTE is days to expiration. Thus, a 30 DTE option has 30 days until it expires. Thus, and the 10 has 10 days to expiration until it expires. 5 days would be a 5 DTE. And guess what? 0 DTEs, those are options that are expiring that day. A 0 DTE option is just an option that has reached its expiration date. That is essentially what it is. I'm going to show you how we got here to the point where we have an expiration in some products that happen every single day. But the thing I want to drive home when I really talk about this is that these are not contracts that were like cooked up in a lab somewhere. Every single option that has existed up until now, and any option that exists after this, is going to or has been a 0 DTE option at some point in its life cycle, namely the last day of its life cycle, the day that it expires. That option, before we had this idea about 0 DTE or even called it 0 DTE, we had options that were expiring that day and were trading. We just called them expiration Friday options. That's basically what we called them. We called them Friday's puts or Friday's calls. And so what we've done here, as we've increased the actual cadence of expiration, and I'll show you this in a moment, is that's all we've done, is added cadence of expiration so that we get a contract that expires every day in some of these products. There's no difference in their contract specs. There's no difference in how their optionality is designed. These are normal everyday contracts that just happen to expire every single day now. Let's talk about how we got here. When I started trading in 98, there were no Friday weekly options. There were no weekly options. When I first started trading, the third Thursday or third Friday of every month was when options expired. And if you traded in DEES, the DEES option expiration was the third Friday of DEES. Jan, third Friday of Jan. All the options expired on that day. And that was it. But what happened is that people started asking for more granular risk, the ability to hedge risk in a more granular way. And so what you get when you're an exchange and your customers start asking you for different ways to hedge their risk, an exchange's responsibility is to respond to their customers. And so that's what they did. The timeline of adding these expirations started in 2005. Friday weekly expirations came on the board on 2005. I want you to think about this before that. I told you, if you were trading in DEES, the third Friday of DEES was when options expired, but previous to 2005. I was standing in the SPX pit, and a circular from the SIBO printed on a piece of paper starts to be handed around the pit. And these things happened all the time. They would be communications from the exchange to the people who were making markets in the actual options. This was kind of how this was before like super electronic communication was part of our daily lives. And we would get handouts. We would get circulars that told us what was going on. And some people would read them, some people wouldn't read them. This was an exceptionally important one to read because what it said was, starting on X date, we will now have Friday expirations in the SPX. You have to imagine from our perspective, we had expirations that were happening every third Friday. And what then happened is we had an expiration that happened every Friday. So from our perspective, the actual risk characteristics of our books started to become much different. And it was kind of a pain, to be honest, at first. And then we started to see the volume start to shift into that. And what happened once people started to see the volume start to shift into those contracts that were expiring on every single Friday is that more people started to hedge their risk that way. And so what you get is 11 years later, the SIBO responding again by adding Wednesday expirations. And then Monday expirations that same year. And then in 2022, they added Tuesday, Thursdays. And we end up with, guess what? An option that expires every day of the week. And that's how we got to this 0DTE kind of environment that people talk about. When they added Fridays, previous to this edition, expirations occurred, like I said, on the third Friday of every month. Volume was concentrated around those expirations, but it was generally more evenly distributed across the option durations. Fast forward to 2016, they add Wednesdays. Wednesdays represented the first time that they had added a different expiration cycle that terminated in the middle of the trading week. Once they started adding Wednesdays, more than 30% of the index volume had already been centered in a weekly contract. You see a lot of rhetoric about how the addition of these 0DTE options or shorter dated options is what has forced people into that the volume shift there. That is not the case. What had happened previous to this is that the volume had started to move and the SIBO was responding to that volume moving, and they added Wednesdays. Then, of course, they added Mondays. Mondays rounded this out. You got Monday, Wednesday, Friday. At the time of Monday listings, we were going north of 30% of the volume being in a weekly expiration. And then, of course, Tuesdays and Thursdays get added in 2022. At this point, 40% or north of 40% of the volume was being rotated into this weekly kind of option. Part of that is because there were just more actual iterations of expiration and people wanted to trade and hedge their risk in a granular way. That's part of what they were asking for and part of what the SIBO basically gave them when they were rolling out these different cadences of expiration. So that's a little history lesson on how we got here. Let's talk a little bit about the options specifically and their relative sensitivity as you take time out of an options life cycle. How does time affect how an option works? Well, you can break it down into a couple of different ways. I like to break it down into the Greeks. The first thing is, how does time affect delta? As expiration approaches, in the money options tend toward the upper bound of 100 deltas, and out of the money options tend toward the lower bound of 0. As time comes out of those options tend more toward their upper and lower bounds. So if you have an in the money option and you pull time out of it, meaning you fast forward one day closer to its expiration, what we end up with is we are theoretically more certain than we were yesterday that this option is going to be or expire in the money. If it's in the money now and you pull one day out, you're more certain that it's going to be in the money. And so what happens is the delta increases of the in the money options. It goes more toward 100. Conversely, the opposite of that is true. If you have an out of the money option and you fast forward the clock 24 hours, one day, you are becoming more certain that that option is going to be out of the money and expire out of the money. And thus, its delta actually goes down. It tends toward the 0 bound. So what you end up with, and I'll show you a graph that shows this, is in the money options tending toward their upper bound of delta and out of the money options tending toward their lower bound of delta, which is 0. 100 is the upper bound, 0 is the lower bound. That's what happens to delta as time comes out. Gamma. Gamma is always highest in the shortest term option and the at the money option. If you're looking for an option that has the most gamma sensitivity, you're going to find it in the at the money option that is expiring in 1 second. That is theoretically where the most gamma sensitive options are. And so as time passes, gamma of those at the money options is going to increase as you get closer to expiration. And for out of the money options, it's going to decrease because they are less sensitive to movement as time goes on. Theta. Theta is how much an option should theoretically decay over a 24-hour period. What you get with theta is that just like gamma, theta is generally centered around the extrinsic portion of an option's value. Extrinsic portion is what is actually decaying over time. Intrinsic value does not decay, or it decays in a very linear way. Theta is centered in that extrinsic portion of value. And so with a 0 DTE option, theta is really concentrated because we have a very limited amount of time. If you have $2 worth of extrinsic value in an option and it has 1 day left until it expires, how much of that extrinsic value has to decay over that 1 day? All $2. Now, if you have an option that has $10 of intrinsic premium in it, and it has 30 cents of extrinsic premium in it, and it has 1 day left, only 30 cents has to decay over the next 24 hours. But keep in mind, all of the extrinsic portion of an option's value has to decay before that option expires. In this case, when you're dealing with 0 DTE options, that means all of that extrinsic value has to come out in 1 day. That's why the theta is increased for options as you get closer to the expiration. Vega. This is an option sensitivity to implied volatility moves. Vega is proportional to time. I'm going to say that again. Vega is proportional to time. That means the more time you put it in option, generally speaking, the more Vega those options have. That also means that those options that are longer term options that have 100 or 200 or 300 days in them are going to be more sensitive to implied volatility movements because they have more Vega in them. They are longer term options. And then commensurately, what you're dealing with when you're dealing with an option that is expiring today is that it has almost no Vega in it. It is not very sensitive to implied volatility movement because it's expiring in 1 day, because it's expiring at the end of the day, and it doesn't have a lot of Vega. Vega is proportional to time. Keep that in mind. All right, let's dive into each one of these individually. Gamma of options. Here's your definition of gamma. We're going to talk about that, and then I'm going to give you a little bit more, like we're going to dig into it as it pertains to the 0 DTE space. Gamma is a delta's sensitivity to stock price. So the anticipated change in the delta of an option for a $1 move in the underlying. Now, all other factors remaining constant, that means that gamma is something that moves an option's delta around, but there's also lots of other things that are moving around. And so you can't just look at an option's gamma and say, this is a great option or this is a horrible option. There are so many pieces that are moving around, but you need to understand how the gamma actually works relative to time because it's an important part of an option's risk profile. It's expressed as decimals in decimal form. We would look at this and say this option has 2 gamma, which means that for every $1 move up or down, the option's delta should move by 2 deltas. It's considered really an adjustment to delta. We think about it as like gamma to me is really, I think about it like the potential energy in an option, an option's ability to change, an option's ability to kind of morph into a different kind of option. And that's what, generally speaking, people are buying when they're buying optionality. They're looking for that ability for that option to change into a different kind of option. And not like a different type of option, but just for its delta to move from a 10 delta to a 50 delta or a 10 delta to a 100 delta. That is gamma. That is gamma at work in an option's risk profile. Let's take a look at the gamma of options across a series of strikes. Remember what I said when I responded, when I gave you like, how does gamma work with time? Gamma is most concentrated in the at the money option that has the least amount of time on the board. What that looks like from a graphic perspective is, think about these as strikes, and we're dealing with a $25 stock here. The amount of gamma that exists in the 25 calls and puts is going to be exponentially more than the amount of gamma that exists on any of these other strikes. Gamma is most concentrated in the at the money options because they have the most ability to change their delta. If the stock moves around from 24 to 26, the at the money option is going to change its delta more than this 30 call is going to change over here. That's because it has more gamma. So that's where your at the money options are. That is where it's concentrated and where the most gamma is going to be. Now let's look at gamma as a function of time, because this is also instructive as to 0DTE options. This is the gamma of an at the money option with varying amounts of time in it. For instance, a 0DTE option might have 15. This is what we would call 15 gamma. Look at it with 5 days. It has 0.06. It has 6 gamma. With 10 days, it has less than 4 gamma. And with 30 days, it has less than 3 gamma. And then with 90 days, it has less than 2 gamma. The biggest leap in the difference here is obviously between the 0 and the 5-day option. And what does that look like when you look at it graphically? It looks like this. This gives you a good idea of how much gamma we're talking about in these 0DTE options relative to a 5-day option or a 10-day option. Keep in mind, this is not that much time differential. This is just next Friday's option relative to today's Friday's option. If we're talking about a Friday expiry, this would be next week's Friday, and this would be today's. That's more than 3 times the actual. It's right around 3 times the actual gamma. That's a big leap. It's important that you understand if you're dealing, and particularly when you're dealing with at the money options. Remember, gamma is most intense in options that are at the money with very little time to expiry. So this is where that 0DTE option obviously lives as far as the gamma profile is concerned. Now let's look at the gamma of options across strikes and durations, because this is where things get kind of interesting. This is your 10-day, 10 DTE option, right? This curve is how much gamma is in those options relative to the strikes. We're talking about like $100 stock right now. These are the $100 calls and puts. And this is like the 120 call, and this is like the 80 put. Keep in mind, as you take time out, this actual gamma profile starts to get more steep. And as you add time in, the gamma profile starts to become flatter, meaning all of these options start to be more like each other from a gamma perspective. They all start to have a little bit more of the same characteristics of movement when you add time to them, meaning farther out in duration, away from expiration. But as you get closer to expiration and you take time out, the actual gamma profile starts to change significantly for the at the money options relative to the out of the money options. What I did when I created this presentation was I originally just had this slide in here. And then I had a friend who's also in the options education space who works for NASDAQ who said, hey, what would this look like if you overlaid the 1 DTE or the 0 DTE option over the top of it? And I thought, you know what? That's a really good idea. So what did we do? We took the gamma of the options relative to strike and duration, which is exactly what I just showed you. As expiration nears, the gamma of these at the money calls and puts increases, and in the money or out of the money calls and puts decreases. That's part of why these curves look the way they do. Remember, this is the at the money option. These are the out of the money options. The gamma is less in the out of the money options than it is in the at the money options. And then if you add time to it, it's still less, but the discrepancy between the ats and the outs is different and becomes flatter. But when you look at this and you add the 1 DTE options on top of it, this is what you get. Notice the discrepancy here. Notice the discrepancy of the amount of gamma that we are talking about in the at-the-money options. This was your previous high of the 10-day option that we were talking about in the previous slide. And this is the 1 DTE option. It's essentially all gamma. This option is almost exclusively a gamma-rich option. And you need to remember that because that is the sensitivity that exists in these options that are about to expire. They're very, very sensitive to underlying movement, especially the at-the-money ones. Now let's shift gears a little bit and talk about Vega. I'm going to give you the same kind of idea here, but we're going to talk about it relative to time. Again, Vega is the volatility Greek. It is an option values sensitivity to implied volatility. When I talked about gamma, I said gamma is how much your delta moves when the underlying moves. And that is true. Vega is how much the value of the option moves when you move implied volatility levels. It is expected change in the option's value, not the expected change of its delta or the expected change of one of its Greeks. It's the expected change of the price of the option, essentially, with a 1% change in the implied volatility. If you're moving implied vol from a 20 to a 21, that option should move its value by its Vega amount. It's expressed in decimal form, just like gamma is. In this case, we would say this has 8 Vega. It represents, again, a cash amount per option. We're talking about how much the actual option's value is going to move. And again, all other pricing factors remaining constant, the Vega is going to move the option's value. Calls and puts both have positive Vega amounts. Whereas delta can be positive on one side and negative on the other side, Vega is the same on both on the strike. They're both positive and they're both the same amount. That means because they both have positive Vega amounts, if you move implied volatility up and you keep everything else constant, an option value should move up by its Vega amount. And if you move implied volatility down, the option value should move down by its Vega amount. What I told you at the beginning is that Vega is actually kind of commensurate with time. It's proportional to time. Let's look at what that looks like from a graphic perspective. And this is going to look very similar to the delta or to the gamma slide that I gave you. We're going to look at Vega of the at-the-money options over those same duration of options, the 0 DTE, the 5D, the 10 DTE, the 30, and the 90 DTE options. Take a look at what the Vega of these options looks like. 2 here, 4, almost 7, 12, and 20. So what is this curve going to look like relative to the gamma curve that we looked like? It's going to look almost exactly the opposite. Vega of at-the-money options increases as you add time to it. Now keep in mind, this is exactly the opposite relationship that gamma has to time. And so what we're dealing with here is at the very front of the curve in these short-term options, these options have very little Vega, meaning they're not very sensitive to implied volatility moves, but they have a ton of gamma. And so when you think about those options, I want you to think about them that way. You need to conceive of those options as gamma rich and Vega poor options. As you go out in time, that relationship changes. Let's look at that in time with both gamma and Vega. Gamma versus Vega of at-the-money options over time. This is that same thing. 0 days, 5 days, 10 days, 30 days, and 90 days. But what I've done here is I've overlaid the gamma over the Vega of that option. So this is what a 0 DTE option looks like. It's basically all gamma and no Vega. Go 5 days out, you've got it more kind of regulated a little bit. It's got a little bit less gamma and a little bit more Vega. At 10 days, you start to get the crossover where it becomes kind of a hybrid option where it has a little bit of gamma and a little bit of Vega. And then it starts to accelerate as you add 30 days and 90 days. The actual gamma of that option starts to come off. It is not as sensitive to movement, but it is much more sensitive to implied volatility levels because it has more Vega over time. Remember, Vega is proportional to time in the at the money option, and gamma has a very interesting relationship with time as well. As you get closer to expiration, the gamma goes exponential on options. They become extremely sensitive to underlying movement. This is where the 0DTE option lives. Almost all gamma, almost no Vega. That's basically what that option is. You're basically trading an option and its ability to capture movement. That's more or less what you're looking at. Let's look at delta over time. This is that situation that I talked about at the beginning when delta of an in the money option tends toward 100 as you pull time out of it, and the delta of the out of the money options tend toward 0 as you pull time out of it. Delta is an option value's sensitivity to underlying movement, to the stock price. It is the expected change in an option's price, up or down, for every $1 move in the underlying price. So you can kind of like subset this into 3 buckets. The deep in the money options, which are high delta options that tend toward the upper bound of 100. The at the money options, which tend to have close to a 50-ish delta, both on the call and the put. And then the far out of the money options, which have low deltas or approaching the lower bound, the 0 bound, 0. These are the options that are 5, 6, 7 standard deviations away to the upside or to the downside. They are out of the money options. Let's take a look at delta versus gamma when you start to look at the strikes. And I'll show you what this means from the perspective of delta of options actually playing out the way that they do. When you have this is a situation where you're talking about basically a $25 stock again. You're going to recognize this. This is gamma profile of options relative to strike. We've looked at this 3 or 4 times now. At the money options have the most gamma. But we haven't seen this. This is delta of these options relative to strike. We're talking about a $25 stock. These are the deep in the money calls. And these are the way out of the money calls. Look at the fact that they have almost 100 delta. Many of these are 100 delta options. But what happens is that as you pull time out, these options tend more toward the upper bound, and these options tend more toward the lower bound. But as this discrepancy becomes more stark, as this part of the curve becomes more tilted, what you end up with is the gamma of the option having to change this option's structure, this option's kind of risk profile, as the stock moves from 25 to 26 or from 26 to 25. This part of the curve is going to be far more steep, and thus the gamma is going to increase, and the change of the option is going to become much more stark as the stock moves. For $1 move, it's going to be a much greater change in the option's characteristics. That's why these 0DTE options are so sensitive to movement, because this delta curve is starting to become very steep as you start to pull time out. Remember, options are moving toward 100 and also toward 0. And the only thing that can happen when you've got something moving like this is that this space in between, which you see right here, has to become more steep. It almost gets to the point where it's almost a straight line when you're getting close to expiration, because all the options up to the 25 strike are going to be close to 100 delta, and all the options above it are going to be close to a 0 delta if you're talking about the calls. So that's what's happening with the delta and the gamma of those options. Let's take a look at the actual real world example to drive this point home a little bit. I call this same move, different result. The reason why is because I'm giving you 3 different situations with the same option but with more and less time in them. So let's start with the 50 delta call. That's a 0 DTE option. It has 0 days to expiry. The underlying is $100. The implied vol is 50, and its price is 105. It has 15 gamma. Remember when we looked at the gamma chart, this had 15 gamma, and like the 10 or the 5-day option had like 6, right? It was 1/3 as much. We're also going to contrast this with the 10-day option. Everything else is exactly the same, except it has 10 days to expiry. The underlying's 100. The vol is still 50. But the call price is $3.53. Why? Because it has more time in it. Because it has 10 days instead of 0 days. Its gamma is far, far, far less than the gamma of this 0-day option. And then we're going to contrast it with the 30-day option. Same 50 delta call, just with 30 days in it. Underlying's 100, implied vol's 50, and the price is $6. It's a much bigger option from a premium perspective because it has more time. What else does it have more of? It has more Vega in it, but it also has less gamma. Now, we're going to take this stock up $5 in all 3 of these scenarios. Stock, you walk in the next day, the stock's trading 105 instead of 100. The new call price of the 0-day option is 502. The new call price of the 10-day option is 670, and the new call price of the 30-day option is 904. Now, you might look at this and think, oh, well, that's not that big of a deal. And I would say, okay, but the 0-day option went up almost $4. The 10-day option went up $3, and the 30-day option went up $3 as well, basically, on the same $5 move. The interesting thing comes in when you start to think about how much this thing moved as a relative percentage of how much it started its life cycle with, price-wise. The 0-day option moved 378% of its original price. And the 10-day moved basically 90%, and the 30-day moved basically 50%. This is what people are talking about when they're talking about the actual risk dynamics of these options. Because if you think about it and you think about how much this call was relative to if you had $10,000 to invest in options, how many of these can you buy relative to how many of these can you buy? It's a significant amount more on this side because they're cheaper, because they don't have as much time in them. But if you get this $5 move and it's a 50 delta option, things can change very quickly as a function of its gamma and the change in its delta. That's what's happening here. This option is changing its delta characteristics. The stock is moving, and because of its gamma and because of its limited amount of time, it is changing its risk characteristics significantly. And less so for these 10-day options, and even less so for the 30-day options. All right. Same move, different result. But we're talking about the same options and a different underlying move. This is the 0-day option. You might recognize it. We just talked about it. Everything's exactly the same here, except we're talking about theta now instead of the gamma of the option. This option's worth $1.05 when we're starting. How much of that is extrinsic value? Well, it's a 50 delta option, so all of it is extrinsic value. Remember what I said about extrinsic value in theta. Theta is centered in the extrinsic value portion of an option's value, meaning if you only have 1 day, all of the extrinsic value has to come out before the end of the day. In this case, all of the option's value is extrinsic value. It has no intrinsic value. And so all of its value is going to come out in theta by the end of the day with the stock where it is right now. Stock movement can change that, but with the stock where it is right now, all of the extrinsic value has to come out. Contrast that with the 10-day option. Remember, it has a significantly different risk profile. It's also worth $3.53. And its theta, it still has 9 more days than this does to come out of its extrinsic value. So what does that mean? Its theta is only 16 cents today. Now that theta number is going to change over time as you get closer to expiration, but today it's only 16 cents for that option. And then the 30-day option is a $6 option, same option we just looked at, but it has less than 10 cents of theta because it's got way more days in it. This theta number is going to go up as you get closer to expiration, but right now it's only got 10 cents of theta. Okay, in the last example, we said the stock came in and we walked in and it was up $5. This time we walk in and we're close to the close and the stock hasn't moved. So what happens to these options? New call price after no movement and a full day? You got it, 0. This option expires worthless. New call price here is $3.36, and the new call price here is $5.91. You might recognize the difference between the call price and the new call price because when nothing happens, generally speaking, the theta of that option comes out of it. And so the difference here between 353 and 336 is roughly 16 cents. That's its theta coming out. Same thing here, right? 601 to 591, you've got about 10 cents of theta. Now, the price differential is massive on the 0 DTE call. Why? Because it's expiring at the end of the day and all of that extrinsic value has to come out. The 10-day call moves by 17 cents. The 30-day call moves by 10 cents, roughly approximating its theta. Now let's look at exactly what this means from a percentage standpoint. 100% of its value came out on the 0 DTE option. That option lost all of its value. The 10-day option lost 5% of its value, and the 30-day option lost 2% of its value. Again, this is what people are talking about when they're talking about the risks that exist with 0 DTE options. Can they move 378% positively? Yes, of course they can. Can they also lose 100% of their value in one day? Absolutely they can. That's what you are dealing with when you're dealing with these options that are particularly close to the front of the curve, when you're dealing with options that are really close to expiration. And this is the point that I want to drive home to you when I talk about 0 DTE options, because lots of people look at them and think about them as an agent of FOMO, right? They are the ultimate FOMO option because many times people will look at them and see a stock that's moving a lot and think about, oh, if I owned the 0 DTE call, I would be instantaneously rich. And sure, that might be the case. But if the stock didn't move and you owned the 0 DTE call, you might have also lost 100% of your actual investment in 7 hours. You get these extreme events because you're dealing with only one price iteration of settlement in the underlying. You have 6 hours or 8 hours until the thing prints for expiration, and that option's life cycle is over. What that gives you is extreme outcomes on either side. And it's important that you understand that when you start to dig in to 0 DTE options. Because as I've shown you, gamma relative to time, Vega relative to time, and delta relative to time are all at their extreme amounts when you're dealing with 1 day to expiration. I showed you lots of graphs that show you exactly what that means relative to time coming out of the option. At every one of those points, it's at its most extreme. Build that into your risk profile when you think about these options, because that's what they look like when you start to pull time out of them. All right, so I hope that we kicked off the 0 DTE conversation with some theoretical knowledge. That's what I'm trying to do here, is to give you a good amount of theoretical knowledge to really start with. I know that sometimes people want to see, like, well, what does the call spread do when you rally? I can show you those kinds of things and we can talk about those things. Really what I want to do is drive home the idea that these options have risks and benefits and be able to educate people as to what they are and how they look when you pull time out of them. So, Jesus, do we have, I was going to look at some questions. Let's see. All right. Here are some questions. They expire in 0 days, but what about settlement? Interesting question. The settlement, if you're dealing with a cash settled option, which SPX options generally are, SPY options, generally index options are cash settled options, and they're also generally European style options, which means they have no ability to early exercise. They can only be exercised at the moment of expiry. The daily options generally print to the PM settlement of the index. Whereas if you're dealing with the traditional third Friday of every month options, which are still listed, those expire on the Thursday previous to the Friday, but then they print to the AM print on the Friday morning. The difference there is that you're dealing with overnight risk that then incurs the actual risk of the print. The print is what we call when the S&P 500 opens, it opens by all 500 of the stocks opening up and then calculating the actual index value, what we call the cash value. And so what you'll see in the morning when all the stocks are opening is that the cash print is like moving around. It's kind of zeroing in on the actual print as you get more of the 500 stocks being built into the calc. And so that risk is significant, that overnight risk. Many times what people like about the 0 DTE options is that they print to the PM. So you know exactly where you're printing like right away. Let's see. How do you trade 0 DTE safely? That's a very, very good question. I think someone answered this. You can trade them as you would any other option to limit risk. You can also use spreads, which I think is an interesting response to that. That is true. You can also place stop losses, also true. And then it said TradeStation's Option Education Center has a lesson on activation rules for stops. So you might want to check that out. That's interesting as well. Let's see. What else do we have here? I think that might be about it for questions. The one thing that I really want to drive home here is that optionseducation.org, where we host all of our educational resources, is the Options Industry Council website, has a lot of resources, as well as the TradeStation education resources are really starting to become much more robust over time. And you should definitely check those out as well, because they're doing a great job of building that out and building out the educational capabilities of the website. The Options Industry Council has been doing options education for almost 50 years now. And so we have a ton of stuff on our website, and it is free for the public because we're fully funded by the OCC. So optionseducation.org is a fantastic resource where you're going to find a lot of stuff. You can also get in touch with us at the email address that I mentioned earlier, options@theocc.com. You can send us email questions and we'll respond to email questions that come in. You can also follow me on LinkedIn, where I do a ton of talking about options and how they work, and also what people call thought leadership about just the options business and how things are developing and different players in the options business and what's happening right now. So you can check that out as well. And you can send me DMs on LinkedIn as well. But I'd really love to push people toward the options education on www.optionseducation.org. It's a fantastic resource. And it's something we've been building out and making more robust every year for the last 50 years. So make sure you...
I was just going to say, Matt, there's a few more questions here that came through the chat. I'm not sure if you have a few minutes.
Yeah, you bet. Let's do it. I've always got some time for questions. Let's see. Can you give me some examples about why would you want to know, and answers from get to knowing Vega and Theta? Why you want to know about Vega and Theta? Well, there are a lot of answers as to why you would want to know about that. Vega is not very concentrated in these 0 DTE options. And so that part of the conversation I build in to make sure that people understand if you're looking for a way to cover Vega exposure, not going to get a lot of Vega exposure out of a 0-day option. Theta is really important that you understand that all of the option's extrinsic value has to come out before the end of the day as far as the option is concerned. And so if you've got an option that's out of the money and it's $2, all of that value is extrinsic. And if nothing happens, that option is going to zero. And so 100% of its value is going to expire out of the money and it's going to go to zero. And so that's really important too. It's important that you think about those things when you're looking at the option, because oftentimes people don't think about that when they're thinking about 0 DTEs. Is there anything on the website about options on futures? We do not trade, we don't clear futures most of the time. And so all of our educational material is based on options on indexes and stocks. But I will say this, having come from someone who has traded options on almost everything, options on futures and options on stocks and options on, on cash and options on all kinds of things maintain the same basics of optionality. And the more you understand about the basics of how the options work, the better equipped you're going to be able to put those things into place, even when you're trading options on futures. Because the underlying changes and the actual niche marketplace might have different, the underlyings might trade a little bit differently, but the optionality is very similar. You need to understand how the niche, different things in different markets react and how that informs how the options work. But the optionality itself is very fungible across your knowledge base as far as options are concerned. Unlocking. Oh, okay. And Jesus puts some really great resources in there for options on futures from the TradeStation side of things. What stocks expire daily was the last question that came in. First of all, stocks don't expire, the actual underlying stocks. And right now, if you're talking about options on stocks, there are not daily expiries on stocks right now. The daily expiries are really focused in the index space. There are, however, weekly expiries on stocks that generally expire every Friday. Make sure you look at the contract specs of what you're trading before you trade them. Sometimes Friday expiries exist on some stocks and not on other stocks. So make sure you understand where it's listed, how many Fridays out are listed, right? Usually I think it's like 2 or 3 months of Fridays that get listed. Sometimes they list them way out. And so that can vary from stock to stock. So you need to check into that. It looks like the bid-ask spreads are wider for futures options versus equity options. Bid-ask spread is a function of liquidity, and it can be very specific to very specific products depending on how many people are involved and how much volume is going through there. If you think about it from a market maker's perspective, the person who is actually providing both the bid and the ask, much of their risk, their operational risks, are built into how wide they make the actual spread, because that is theoretically how they get paid to provide liquidity. And if you're looking for a price to sell something at, that person has to be the person who buys it from you. They will have a fair value in their mind as to what they think it's worth, and their fair value is going to be in the center of their bid-ask spread. But if something is extremely illiquid and doesn't have the ability for them to get out once someone sells it to them, they're going to have to build in more of a spread between the bid and the ask in order to actually be compensated for the amount of risk that they're taking. Sorry. Looking at ES versus SPY and NQ options versus QQQ. Yeah, so that's, the bid-ask spread is going to be a function of how many people are involved and how much volume is going in there. On 0 DTE options and the SPX, where do you see the most institutional activity, long or short side? You need to pay attention to listen to what the SIBO is saying on this specific idea. What they're saying is that they're seeing a very balanced makeup of buyers versus sellers, that it is slightly tilted, I think, toward the retail trader being the buy side. And when I say slightly, I mean like 51% to 49%. Like it's very slight. But I also think that, those kind of metrics change on a daily basis. So you need to but one thing I will say about the SIBO is that they've been extremely transparent about how these options are developing and how they have developed from a volume perspective. And they're being really transparent about, giving people information about how that space is transforming over time. Someone who's particularly good at that is Mandy Zhu, who is I think their head of options data. She's a great communicator and she does a lot of really good stuff. They also have a weekly, it's called I think it's like the Volatility Digest, which comes out every week that you can subscribe to on the SIBO website, which is fantastic. You can check that out. Let's see. Don't you want to do 0 DTE on cash settled underlyings? I mean, the 0 DTE options generally are only on the indexes, which are generally cash settled underlyings. So they do exist on the cash settled underlyings right now, but I don't see any reason why, if the industry is responding to people asking for it, that they couldn't be on things that convert into other things other than cash. It would be more complicated, obviously, to deal with the amount of settlement from a stock perspective that comes from an option converting into stock every 8 hours. But I also think that, we just recently moved from T+2 to T+1 to T+, theoretically, if you think about it, we're moving to the T0 world. And as that starts to happen more quickly, I think, the capabilities for the industry to actually absorb that kind of operational risks are there as well. I'm not saying it's going to happen anytime soon, but it could. I think that's about it. Jesus, I think we might have answered all the questions.
Hey,
Great.
Matt, I want to appreciate your time. Thank you for joining us today. For those that are joining, Matt is going to be here in future events. So make sure that you check our events calendar to look out for his presentations. They're always very appreciated. So Matt, thank you so much.
Absolutely. Thanks for having me. I look forward to the next time we can do this.
Excellent. Everyone, have a wonderful afternoon, and I'll see you next time. Have a wonderful day. Goodbye.